Welcome to the second part of the cash in cash equivalent. So in this part 2 of the cash in cash equivalent, we will learn about bank overdraft, compensating balance, stale checks, petty cash fund. So let's start with a bank overdraft. And how do we create a bank overdraft? When a company draws a check more than the amount in the account balance, it creates a bank overdraft. Generally in the Philippines, bank overdraft is not permitted, but it does happen. As an accountant, you have to know what to do. 2 things you have to remember on the bank overdraft. Is the bank overdraft from a same bank or is the bank overdraft from a different bank? So if the bank overdraft is from a different bank, 2 things you have to remember too. Is the amount material or is the amount immaterial? Now, the materiality principles or the materiality of an amount depends on your judgment as an accountant in real life. But in the actual exam, the problem will tell you whether the amount is material or immaterial. If the amount is material, then we cannot. So what do we do if we cannot offset the amount of the bank overdraft? Then we are going to recognize that, or we are going to report that amount as liability. Now, if the amount is immaterial, the bank overdraft amount is immaterial and it's from a different bank, then we can offset. We have to make a captions on that account, cash. Now, how about if bank overdraft is from a same bank? If it's the same bank, meaning to say the company is maintaining more than one account. So let's say, for example, one account has an overdraft and the other one is not. So we can offset the overdraft account to the other account. So on the same bank, whether this is material or immaterial in amount, we can both offset. So the only way we cannot offset a bank overdraft is when the overdraft is from a different bank and the amount is material. Otherwise, if it's different bank but the amount is immaterial, we can offset that. Also, if the bank overdraft is on the same bank, we can offset the amount. And on the captions, we will put cash net of overdraft. That's our bank overdraft. Compensating balance. A compensating balance is a minimum balance maintained in a bank account. We create a compensating balance when the company borrows some money in a bank and the bank requires the company to maintain a minimum amount in the account. That is called compensating balance. So it creates that compensating balance from that borrowing of the money. How do we account the compensating balance? 2 things we have to remember on compensating balance. If the compensating balance is legally restricted or not legally restricted. So what do we do if it's legally restricted? So if this compensating balance or this amount of cash is legally restricted, we can classify this either short-term or long-term. If this loan that creates the compensating balance is for short term, then we classify this as current asset. If it's a long term, then we classify this as the cash account is. That's your caption. That's how we account for our compensating balance. Now, we'll talk about stale check. When do we call a check stale? When a company draws a check and delivers to the payee and the payee hasn't gone to the bank to encash the check for 6 months. This check is called stale checks. So what do we do with the stale checks? How do we account for the stale check? 2 things you have to remember. If the stale check is material in amount or the stale check is immaterial in amount. Whether this is material in amount or immaterial amount, we are going to revert it back into our cash in bank. The only difference between these 2 is that on materials, we revert it back to cash in bank, which we debit cash in bank and we credit accounts payable. So we are going to revert it back to our accounts payable. The stale check that is material in amount. If the amount of the stale check is immaterial, we revert it back to cash in bank. but we are going to credit a miscellaneous income. By the way, not legally restricted, we are going to classify this as cash. Not legally restricted, meaning to say it's unrestricted. Remember the cash that we discussed or we learned, to be able to classify that as cash, it should be unrestricted. So this compensating balance is not legally restricted, meaning to say it's unrestricted, then we are going to classify that as cash. And it's to your checks. So if it's material or immaterial, both we will revert it back to cash in bank, but the difference is when it's material, we credit the accounts payable, and if immaterial, we credit the miscellaneous income. Alright, now let's talk about petty cash fund. What is a petty cash fund? A petty cash fund, this is a small amount of cash segregated by the company in payment of the company's small expenses. So how do we account for the petty cash funds? Usually there's one person that takes care of the petty cash fund or handles the petty cash fund, and this person is called petty cash custodian. So how do we account this petty cash fund? We have two systems that we use in accounting for petty cash funds. These are the two systems that we use in accounting for petty cash funds. It's either we use impressed fund system or fluctuating fund system. So let me draw, putting a columns on this to show you the difference, the comparison of the journal entries using these two methods. But before we jump into the journal entries using the two methods, let me give you an examples of the expenses where we take that money from our petty cash fund. These are the examples of our expenses where we take the money from our petty cash fund. These are examples of expenses except for one. This first item right here is advances to employees or officer. This is not an expense on the part of the company. This is classified as other receivables. This is also called IOUs from employees or officers. Let me write down our transactions here so we can do our journal entries. These are the transactions that involves the account petty cash fund. First transactions is establishment of the fund. Whether we use impressed fund system or we use fluctuating fund system, our journal entries is the same. Our entry will be debit to petty cash fund and credit to cash in bank. The same way with the fluctuating fund system, we debit petty cash fund and we credit cash in bank. So whether you use impressed fund system or fluctuating fund system, your entry will be the same. The second transactions, disbursement. A disbursement is when the petty cash custodians takes the money from the petty cash fund to pay small expenses. So under impressed fund system, the custodians will enter what we call memorandum entry. A memorandum entry is a short message entered into the general journal. This is not a complete journal entry because it doesn't have a debit or a credit entry. So memorandum entry. Under fluctuating fund system, on the other hand, the custodian will enter a journal entry. Entry is debit to the expenses and credit to petty cash fund. This is one of the differences between the two methods. When a custodian disbursed the money under impressed fund system, the student only makes a memorandum entry. Under fluctuating fund system, the custodians will enter the journal entry, and the entry is debit to expenses and credit to petty cash fund. As you can see, the fluctuating fund system, the amount of petty cash fund is fluctuating because we credit the petty cash fund. Under Impress systems, we still have the amount of the petty cash funds that we established. Third transaction is replenishment. A replenishment is when you recharge petty cash fund. So you put more money on the petty cash funds. So that is replenishment. Under Impress fund system, the entry will be debit to expenses, credit to cash in bank. Usually on replenishment under Impress system, they replenish whatever the expenses on the petty cash fund. On replenishment, we debit expenses and we credit cash in bank. On the other hand, on fluctuating fund system, when we replenish the petty cash funds, we debit petty cash fund. So under Impress fund systems, we recognize the expenses when we replenish the petty cash fund. Under fluctuating fund systems, we recognize the expenses as it occurs on fluctuating fund system. Now, increasing the amount of our petty cash fund. Sometimes the company realizes that the amount in petty cash fund is not enough. So we increase the amount of our petty cash funds. Under Impress fund system, if you increase the amount of petty cash funds, we debit petty cash fund. Same way with the fluctuating fund system. We debit petty cash fund, then we credit cash in bank. Decreasing the amount of petty cash funds. The company realized that the amount in the petty cash funds is too much. So we have to decrease the amount of petty cash funds so we can use it for something else. So if we decrease the amount of petty cash funds, under Impress fund system, we debit cash in bank and we credit to petty cash fund. We put it back in our cash in bank. Same way with fluctuating fund system, we debit cash in bank and we credit petty cash fund. At the end of the year, we do some adjustments under Impress fund system. Any unreplenished expenses should be recognized at the end of the year. So any unreplenished, we debit expenses to recognize expenses, and we credit the petty cash fund. Under fluctuating fund system, we don't adjust any of the expenses because we recognize the expenses as it occurs. So every time we have expenses, we record that right away under a fluctuating fund system. So under fluctuating fund system, we don't have an entry at the end of the year. So this is your petty cash fund.